Well, good day, traders. Chris Weston here, Head of Research at Pepperstone. I continue to watch what's happening in the S&P, not just because it drives the MSCI World Index, it has a big influence on its variability, but it has such an important variable on what's happening in the Australian market. Of course, things like auction clearance rates have had a big impact on the ASX financial sector. We're coming up into an election, and that's going to probably take hold, or how much of that is priced in. If we look at implied volatility in the Aussie dollar, people are not seeing fireworks around the election. They're not seeing that as a volatility event. So I continue to watch what's happening in global equity markets, and really the S&P continues to be right at the middle part of that ground. We continue to be driven by what's happening in central banks. I think probably the new news is really what's happening with the ECB. They've opened up the door for a tiered deposit structure, which will be somewhat positive for the banks if it's enacted when that potentially comes through in June. It could impact the idea that they could come out with an interest rate cut as well. So they'd actually look to tier or stagger the deposit rate at the moment, which is negative 40 basis points, and offset that with a rate cut. Now it could be quite good for financial conditions in Europe. And in fact, if we're actually seeing what some of the rhetoric and people reading between the lines, Mario Draghi, who's only got 6 months left on his tenure, is almost saying to us that if they have to use quantitative easing again, then perhaps they could actually come out and buy equities. When we start seeing that situation, then we should really think about buying the DAX and Euro stocks markets, and certainly banks, because I think those are really going to outperform going forward. But what we're seeing is a situation where the dynamics in market continue to support equities. If I have a look at real yield in global markets, which is the inflation-adjusted bond yield, that's continued to start roll over and start heading lower. The equity market loves that situation. If you have a look at inflation expectations, specifically in the US, they sit around 2.03%, which is perfect for equity appreciation. It's at a level where central banks don't need to act, but it's not at really concerning levels. That is, apart from Europe, where we're seeing inflation expectations continue to head lower, and it's part of the reason why Mario Draghi has to be continuously cautious in that situation. If we have a look in the US based on the cyclical versus defensive ratio, I want to look at that as a beacon of how much risk-taking is playing through. That's sort of gravitating sideways at the moment. It's not really giving me any belief, and I think that's a fair situation about what's happening in the S&P itself, where valuations are pretty fair. They're in line with the long-term average. Markets are asking themselves, what is the next catalyst to take us higher in the S&P through 2900, and again that should have then positive ramifications for global markets. If we have a look at the oil price at $64 or so, I think again that's a positive. It's making sure that real yield stays low, the break-even levels are moving higher, and nominal bond yields are moving lower, and therefore we're seeing a situation where real yields are moving lower in that situation. The put-call ratio in the S&P is starting to meander a little bit higher. People are taking some of those put options off the table, and that's been somewhat of a bit of a positive. The leverage community is very much short S&P futures. We can see that in the Commitment of Traders report, and the high yield spreads relative to investment grade spreads continue to tighten. That's an equity positive in itself. I feel like at market internals, we can have a look at the number of companies above their 50 and 200-day moving average, and they're not at extremities either. So if I have a look at all these variables that I look at in the S&P, not just valuations, but market internals and some of the other metrics, we can see we're stuck in this kind of hiatus at the moment. There's really no reason to be looking to short the market any kind of depth. Implied volatility in the VIX is just still under 14%. It's no real reason to suspect we need to take cash off the table in any kind of shape or form. And these are the factors that will really guide me to say that we're going to see a big pullback in markets, or whether or not we're going to continue to going higher. At the moment, the market seems a bit lost. Perhaps this is going to come from the US earnings seasons. We need corporate CEOs to say that the outlook's much better. It's pretty rosy, that what's happening in tax reform has not dissipated too much, that the outlook for relations between China and the US is not affecting their businesses too much, what they're seeing about commodity prices, what are they saying about the US dollar, and all these various factors will allow us to market what's going on in the US and global economies relative to valuation, and potentially then push us through 2900 on the S&P, which of course would be good for the ASX 200 as well.